Greetings and welcome to Avaya Fiscal 2020 Fourth Quarter Conference Call. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero on your telephone keypad. Please note this conference is being recorded. I will now turn the conference over to Michael McCarthy, Vice President of Investor Relations. Thank you. You may begin.
Thank you. Welcome to Avaya's Fiscal 2020 Fourth Quarter Investor Call. Jim Cherico, our President and CEO, and Karen McGrath, our Chief Financial Officer, will lead this morning's call and share with you some prepared remarks before taking your questions. Consistent with social distancing mandates, each of us on this morning's call are assembled from our remote locations. The earnings release and investor slides referenced on this morning's call are accessible on the investor page of our website, as well as in the 8-K filed today with the SEC, which should aid you in your understanding of Avaya's financial results. We will reference non-GAAP financial measures and specifically note that all sequential and year-over-year comparisons reference non-GAAP numbers, except where otherwise noted. We have included a reconciliation of such measures to GAAP in the earnings release and the investor slides. We may make forward-looking statements that are based on current expectations, forecasts, and assumptions, which remain subject to risks and uncertainties that could cause actual results to differ materially. In particular, our business is currently being impacted by COVID-19 and its effect on the global economy. The extent of its continued impact on our business will depend on a number of factors that include, but may not be limited to, severity and duration, as well as actions taken and not taken by governments, businesses, and consumers in response to the pandemic, all of which continue to evolve and remain uncertain at this time. Information about risks and uncertainties may be found in our most recent filings with the SEC, including our Form 10-K and subsequent Form 10-Q reports. It is Avaya's policy not to reiterate guidance, and we undertake no obligations to update or revise forward-looking statements in the event facts or circumstances change, except as otherwise required by law. I will now turn the call over to Jim.
Yeah, thanks, Mike. Good morning, and thank you to everyone joining our call. I'm very pleased to share our quarterly and full-year results with you this morning. Avaya's Q4 was by all measures an exceptional quarter and was the capstone to a remarkable year for the company. We delivered on our financial commitments, drove significant shareholder value, and delivered innovations to our customers throughout this highly dynamic, competitive, and challenging environment. Just 3 years ago, we laid out a strategy to be a leader in digital transformation for enterprise customers and to transform Avaya to a cloud and SaaS company. Our performance this quarter is proof that we are executing and making significant progress on that strategy. What is even more compelling is that digital-first initiatives have accelerated, and I believe we are uniquely positioned to lead and provide our customers with scale, reach, security, and innovation required to tackle these new challenges and opportunities head-on. I cannot be more excited about our future. Before moving to the numbers, let me say how proud I am of our team's focus, commitment, and resiliency during a period of adversity and great uncertainty. Their dedication to our customers, partners, and each other has been nothing short of amazing. With that, let me hit the headlines. Avaya's Q4 was a quarter where outcomes were driven by outstanding execution, hitting on all cylinders across every dimension of the business. Q4 non-GAAP revenue was $757 million, above the high end of our guidance. Revenue was up $35 million from Q3 and $31 million from the prior year. This was our second quarter in a row where we posted quarter-over-quarter and year-over-year growth. Adjusted EBITDA was $200 million, or 26.4% of revenue, which also exceeded the high end of guidance. Cash flow from operations was $70 million, and we ended the quarter with $727 million of cash. With regards to our capital structure, we continue to strengthen our financial position. We refinanced $1 billion of debt and executed an $800 million term loan amend and extend. These moves extended our debt maturities, reduced refinancing risk, and improved our financial flexibility. We delivered excellent results, not just growth, but profitable growth. And I'm delighted with our progress and the foundation we laid going into fiscal 2021. Now to the details on some key areas of momentum. First is the progress we continue to make on our CAPS, our Cloud Alliance Partners, and subscription revenue metric. CAPS during the quarter grew to 33% of revenue, up approximately 15%. And in less than 1 year, we have doubled our CAPS revenue to $1 billion run rate business. CAPS is also important because it truly represents how far our business has come as a cloud SaaS company and is indicative of our transformation. Our CAPS growth not only highlights that we are on the right path, but it further demonstrates the relevance of our technology and solutions in today's market. The subscription component of CAPS is activating our base by bundling additional innovations like Avaya Spaces, video, remote working, AI, and contact center, along with a number of other cloud solutions, allowing customers to consume on demand. It also provides a seamless gateway to transition from on-premise to cloud deployments, resulting in significant growth in our enterprise hybrid business. Proof of its success is in the numbers. In Q4 alone, we signed over 100 subscription deals, totaling a TCV of nearly $200 million. Let me share a significant subscription win and competitive displacement in the financial services industry. One of the largest banks in the U.S. is at the forefront of using technology as a competitive differentiator in more than 1,000 retail branches and offices across 40 states. Avaya is enabling their migration to the cloud. With our subscription solution, they will transition over 70,000 users from using Cisco to Avaya in their retail branches, while also supporting an increasing population of remote workers. A second example is from the healthcare industry, where Allina Health, an enterprise customer that operates in over 100 hospitals and clinics, made the decision to transition 47,000 UC and CC seats to subscription to support a key corporate initiative. Our solution provides them the flexibility to more easily support their remote agents as they cope with the safety, operational, and customer service challenges posed during COVID. Now, let me move on to the cloud component. Specific to public UCaaS, September was our second full quarter in the market with Avaya Cloud Office. We also launched in Australia, Canada, and the UK. Not only are we gaining traction with our install base, but we are seeing success in new customer acquisition. In Q4, we more than doubled the number of customers and more than doubled the number of active partners and agents that sold our solution. While still in the early innings, we are really excited about the adoption across all segments, including enterprise. One such example was the Art Institutes, a system of private schools throughout the United States. They selected Avaya Cloud Office to support 700 users across 8 campuses. Over the 5-year agreement, Avaya will play a critical role in helping the Art Institutes manage their multi-location requirements with increased flexibility, functionality, and centralized operations. Yet another example comes from Canada. Connex is a key business partner of Avaya that is at the forefront of providing UC solutions to the Canadian market. They found that Avaya Cloud Office best fits their needs for seamless integration into their business services across multiple North American offices. International expansion of Avaya Cloud Office continues. At the end of September, we launched in France, Ireland, and the Netherlands. And just last week, we announced the expansion into 5 other European markets. By the end of this calendar year, the solution will be available in 12 countries. Turning to Avaya OneCloud CCaaS, our pipeline continues to grow, and we are seeing significant traction in the U.S. and Canada, where the solution is currently available. One customer, a large social services agency on the East Coast, selected Avaya OneCloud CCaaS for over 1,000 contact center agents and supervisors who support nearly 1.8 million low-income citizens. Avaya's solution was chosen to enable remote work capabilities while also helping to improve response to inquiries about essential benefits. Turning to another example, in Harris County, Texas, the third largest county in the U.S., we created a hybrid solution to support COVID-19 case investigations and contact tracing. With this solution, the county can reach individuals and trace contacts through automated outbound notifications. As a result, the county has increased case investigation capacity by nearly 25%. We are continuing to rapidly build out CCaaS capabilities while also teaming with our ecosystem of partners. One example is with Verint, one of our most strategic and long-term partners. Back in October, we jointly announced cloud-hosted workforce engagement solutions. This complements our CCaaS solution and will accelerate customer adoption. Our next release at the end of December broadens our API-first approach with a digital framework to support messaging, chat, email, and custom channel integration. Let me close with our private cloud solutions. Demand remains strong, and customers are making large, long-term commitments to our private cloud platform. We are able to set up private implementations with the same speed of public, and we are doing so on a global basis. This is fueling opportunities, especially with customers in industries where public cloud either isn't available or cannot meet the stringent security, regulatory, or privacy-related requirements of their businesses. One example is with a global provider of CRM and BPO services. Realizing public cloud would not address their needs, they leveraged our One Cloud solution in a private cloud deployment in order to consolidate their Avaya third-party solutions into a single unified framework, which includes workforce management, speech analytics, quality management, and encryption. Shifting to Avaya Spaces, our workstream collaboration platform, we are seeing significant increase in new seats and usage, which more than doubled sequentially. Although this solution was only rolled out 9 months ago, it was already featured in the Gartner Magic Quadrant for meeting solutions. This offering is available in nearly 100 countries and includes voice, video, chat, messaging, and team rooms. Spaces is continuing to make a difference around the world. Technology security is a significant issue for one of the largest energy companies based in the Middle East. 40% of their staff work is on site, and security compliance prevented the use of remote working solutions to connect on-site teams with remote teams. This had a major impact on team efficiency and productivity. Spaces not only offered the collaboration capabilities they needed, but was able to address the security concerns. Closer to home, St. John's Lutheran School, just outside Chicago, transitioned their entire student body to an immersive online learning program in August. The school is using Avaya Spaces exclusively, and after seeing great success in the classroom, St. John's is now using Spaces for their ongoing operations, including faculty and board meetings. We are continuing to make significant strides in our workstream collaboration platform and recently announced a strategic partnership with NVIDIA to further improve the user experience by removing background noise, adding virtual green screen backgrounds, and adding the ability to generate live transcriptions. Lastly, on the strategic partner component of CAPS, we continue to drive significant new growth opportunities with partners such as Affinity, Google, Nuance, Salesforce.com, and Verint, to name a few. And let me just share a couple highlights. Just last quarter, we announced the availability of Google Conversational AI Solution. Since we launched, we've booked well over a dozen new deals and continue to build a robust pipeline of contact center customers looking to leverage this capability. Another example is with Verint, where we just announced the integration of Verint Knowledge Management with Avaya One Cloud CCaaS. This is an important capability that will accelerate adoption of our CCaaS platform. As digital transformation continues to accelerate, companies have reprioritized their own strategic initiatives, thereby creating an opportunity for Avaya to lead in this space. The combination of these offerings and capabilities drives our ability to close large global opportunities that most others simply cannot. The proof? In Q4 alone, we signed 135 deals with a TCV of over $1 million. This represents a 30% increase from the prior quarter and is by far the largest number of deals of this type that we've signed in the last 2 years. In total, these represent well over $400 million in TCV. 17 of these deals were greater than $5 million, and 4 were greater than $10 million, with one deal over $25 million. In the face of a worldwide pandemic, where almost all of our commercial operations are being conducted virtually, we won over 1,500 new logos in the quarter, nearly a 75% increase from Q3. This is not only a testament to our ability to win deals from the competition, but to the relevance of our technology and the trust customers place in an established brand to support their mission-critical needs. I'm extremely proud of these results, and especially of our global teams, which have shown amazing tenacity and resolve throughout this fiscal year. In FY20, we made significant steps forward in our cloud and SaaS transformational journey. Let me summarize 4 key focus areas for the year. First, we have successfully positioned the company for growth. We posted 2 quarters of quarter-over-quarter and year-over-year growth, and our all-important CAPS number grew from 15% to 26% of revenue in FY20, representing a 73% growth. Second, we have maintained our profitability while reinvesting in the business. For the full year, our adjusted EBITDA was $710 million, or 24.7%, exceeding last year's performance. Third, we continue to innovate across our entire portfolio of solutions. Our teams won another Edison Award. Avaya Spaces was added to the Gartner Magic Quadrant. We introduced public UCaaS and CCaaS offerings to the market. And on the AI front, we are making significant investments, both organically and through partnerships with Affinity, Google, and NVIDIA, among others. Lastly, we made decisive moves to enhance shareholder value and improve our capital structure through effective execution of our share repurchase program and by improving our balance sheet by paying down debt and extending maturities. By all measures, it was an exceptional year across multiple dimensions of our business. Looking forward, as we continue to build on our momentum and reposition the company, we will begin reporting annual recurring revenue, or ARR, as a new performance metric. Not only will this provide increased transparency into our cloud growth, but it measures us against our cloud peers. Kieran will share additional details, but let me give you a snapshot of FY20. Overall, ARR grew by more than 400% year over year. Contact center and our hybrid businesses were significant contributors to this growth. With that, let me turn it over to Kieran.
Thank you, Jim. Good morning, everyone. As a reminder, unless otherwise stated, all financial metrics referenced on this call are non-GAAP, and the supplementary slides posted on our investor relations website set forth the GAAP to non-GAAP reconciliations. All figures mentioned in this call are as reported unless otherwise indicated in constant currency. For the quarter, non-GAAP revenue was $757 million. This compares to $726 million reported a year ago and $722 million in Q3 of fiscal 2020. As a reminder, during the quarter, GAAP and non-GAAP revenue have converged, and the non-GAAP differences generated by fresh start accounting are now immaterial. However, non-GAAP adjustments were material in fiscal year 19, and so from a year-on-year comparison, we speak to non-GAAP revenue for proper comparisons. We expect this to be the last quarter that mentions non-GAAP revenue comparability. Our 4Q performance was led by North America, which delivered strong year-on-year growth for the third quarter in a row. North America's 4Q results also benefited from a larger contribution from the U.S. government sector than we had originally guided, specifically because of the timing of deliverables associated with the Social Security Administration contract. As Jim mentioned earlier, revenue contribution from CAPS, or Cloud, Alliance Partner, and Subscription, remains a strong indicator of the rapid transformation of our business. This quarter, CAPS represented 33% of total revenue, up from 30% in 3Q. CAPS for full year fiscal 20 in aggregate came in at 26%, which compares to 15% for the full year fiscal 2019. We continue to see growth from our subscription and strategic alliance partner offerings, further proof that OpEx and cloud consumption models are much preferred in the market over the historically dominant CapEx engagements. As more of our software is contracted via subscription, the shift of our perpetual license business to an OpEx model benefits the services segment, while it adversely impacts the product and solutions segment. We are seeing this rebalance while still maintaining the same high levels of revenue coming from recurring streams and from software and services. For our fourth fiscal quarter, recurring revenue accounted for 63% of total revenue, with software and services accounting for 88%. Fourth quarter product revenue was $269 million, compared to $315 million in the year-ago period and $262 million in Q3. As I just mentioned, within the product segment, we saw the impact of the shift to subscription, as well as continued declines in hardware driven by long-term market trends and exacerbated by the COVID pandemic. Benefiting from subscription, fourth quarter service revenue was $488 million, up from $411 million in the year-ago period and $460 million in fiscal Q3. Throughout the second half of fiscal 2020, subscription adoption has increased both from the conversion of COVID temporary free licenses and the continued rapid acceleration of our customers driving a digital transformation across their enterprise. Digital transformation initiatives have helped increase contact center revenue contribution of our total business from just about 30% of our revenue 2 years ago to 40% for all of fiscal 2020. Turning to our gross profit metrics. Non-GAAP gross margin was 61.2% in the fourth quarter, compared to 60.6% in the year-ago period and 61.1% sequentially. Non-GAAP product gross margin was 60.2%, compared to 64.4% in the prior year and 60.7% in the third quarter. A larger revenue contribution from our strategic alliance partners in the quarter contributed to the quarter-on-quarter product gross margin decline. Non-GAAP services margin continues to improve, driven by subscription. This quarter, services gross margin was 61.7%, compared to 57.7% in the prior year and 61.3% in Q3. Turning to total profitability margin and cash flow metrics, which were strong for both our fiscal Q4 and fiscal year 2020. Fourth quarter non-GAAP operating income was $170 million, representing a non-GAAP operating margin of 22.5%, down 20 basis points year-on-year, while adjusted EBITDA was $200 million, representing an adjusted EBITDA margin of 26.4%, up 110 basis points year-on-year. Our continued disciplined operational execution and additional cost savings related to COVID, such as minimal levels of travel and expense, offset cloud, R&D, and go-to-market investments made in the business during the period. Turning to cash flow. We generated $70 million in cash flow from operations, or 9% of total revenue, contributing to a fourth quarter ending cash balance of $727 million. As a reminder, this cash balance reflects the repayment of the $50 million revolver draw that was repaid in July. As for the full fiscal year, our CFFO totaled $147 million, representing 5% of revenue. While on the topic of cash, during the quarter we took advantage of favorable market conditions to extend our debt maturities by using the proceeds from a $1 billion senior notes offering to execute a partial paydown of our term loans. In addition, we extended maturities on another $800 million of term loans for 3 additional years. between the notes offering and the term loan extension, we moved approximately $1.8 billion of maturities from 2024 out to 2027 and 2028. These actions extended weighted average debt maturities from 4.1 to 6.1 years, enabling us to reduce financing risk and improve financial flexibility. Summarizing fiscal year 2020, non-GAAP revenue was $2.879 billion compared to $2.908 billion reported in the year-ago period. Non-GAAP operating income was $610 million, representing a non-GAAP operating margin of 21.2%, down 40 basis points year-on-year. Adjusted EBITDA was $710 million, representing an adjusted EBITDA margin of 24.7%, up 40 basis points year-on-year. And finally, we exited the year with a CAPS run rate that is more than double where fiscal year 2019 ended. In addition to the performance we guided to and delivered upon, our capital allocation program for the year was successful across several fronts. We opportunistically bought back 26% of our outstanding common shares at well below current trading levels. We repaid a significant portion of our long-term debt, and we improved our capital structure by extending debt maturities. Now, turning to guidance for 1Q21 as well as full year fiscal 21. Please note that all year-on-year revenue changes are expressed on a constant currency basis and all revenue amounts reflecting rates as of September 30th, 2020. For the first quarter of our fiscal year 2021, we anticipate GAAP revenues of $710 million to $730 million, representing growth at the midpoint year-on-year. We expect non-GAAP operating margin for the first quarter to be between approximately 20% and 21%, and our adjusted EBITDA margin to be between $165 and $180 million, or between approximately 23 and 25% of revenue. Looking forward towards fiscal year 2021, we expect full year GAAP revenues of between $2.875 and $2.925 billion, representing a range of flat to 1% revenue growth as measured in constant currency. This estimate reflects continuing caution concerning uncertainty of a COVID-related resurgence on businesses globally, as well as reflecting that more of Avaya's 2021 subscription bookings will be coming from our Avaya One Cloud public and private cloud offerings in the second half of fiscal 2021, which are ratable transactions from a revenue recognition perspective. We expect non-GAAP operating margin to be between approximately 19% and 21% for the full fiscal year. Similarly, our adjusted EBITDA margin should range between $660 and $710 million, or between approximately 23 and 24% of revenue, reflecting a continued increase in cloud R&D investments, as well as go-to-market spending, especially in sales and marketing of our cloud offerings in the channel. Additionally, we anticipate that travel and expense will likely be returning to more normal activity levels in the second half of fiscal 2021, with anticipated lessening of the impacts of the COVID pandemic. In terms of cash flow from operations for full fiscal year 2021, we expect to be between 2 and 3% of full year revenue. This is primarily due to the expected continued acceleration in our shift to a subscription licensing model, which extends out the cash conversion cycle versus the prior predominantly CapEx licensing model, which has cash receipts more closely aligned with revenue recognition. At this time, we expect our shares outstanding to be between approximately 80 and 85 million shares at fiscal 2021 year end. Now, before I hand the call back to Jim, I'd like to spend a few moments expanding on our existing CAPS transformational metric, as well as provide some context around another metric that we are introducing aimed at providing enhanced visibility into Avaya's progress towards becoming a recurring subscription and cloud company. As a reminder, we introduced the CAPS metric at the beginning of fiscal year 20. As you've seen from our results, we've made great progress during the year and actually exceeded our 30% long-term target in the second half of the year, a full year ahead of schedule. This was largely due to the rapid uptake of Avaya One Cloud subscription. In fiscal 2021, we expect the share of CAPS revenue will continue to grow meaningfully due to the continued acceleration of our Avaya OneCloud family of offerings. We therefore expect that for the next fiscal year, CAPS will represent between 35 and 40% of our annual revenue, up from 26% for all of fiscal 2020. To give investors a better forward-looking view into our broader-based OneCloud software solutions driving our growth, we are introducing a new annualized recurring revenue metric, or ARR. This metric is similar to what our industry peers report and will reflect only the recurring components of Avaya's OneCloud portfolio, which includes multiple deployment options based on customer choice. We believe the OneCloud ARR provides investors with a better view into our long-term revenue growth potential and trajectory. Our OneCloud ARR grew from $35 million at the end of fiscal year 19 to $191 million exiting fiscal year 20, after just 1 year of our OneCloud solutions being in market. Our expectation is that our OneCloud ARR will double by year-end fiscal 21, approaching 15% of our revenue. We anticipate as we exit fiscal year 23, it will represent over $1 billion of annual revenue. As we rapidly transition to this new model, we do expect that there will be headwinds to our cash flow during the fiscal year 21 and fiscal year 22 period, as a subscription versus CapEx sales drive significantly different cash flow dynamics. To explain some of the puts and takes during our revenue model transition, we have included in our supplementary earning materials a simple illustration on slide 18 of revenue recognition and its associated cash flow for a typical premise-based subscription deal. In comparing the mechanics of a legacy perpetual license against subscription, the billing and cash flow of the latter follows a ratable pattern typical of a SaaS model. In this example, revenue recognition precedes cash flow, creating a working capital headwind in the first year and a tailwind in years 2 and 3. Because of this, we will see a reduction or a deferral in cash flow in fiscal years 21 and 22. As we exit fiscal 2023, we believe we'll return to our long-term CFO target levels of between 10 and 13% of revenue. It is our belief that the OneCloud ARR metric will cut through any noise created by the transition and provide a better gauge of our progress to a cloud business model. In summary, we believe the introduction of our OneCloud ARR metric, combined with our existing CAPS metric, will provide investors enhanced visibility into Avaya's transformational cloud journey. With that, I would now like to turn the call back to Jim. Jim?
Thank you, Kieran. Almost 2 months now into our new fiscal year, I cannot emphasize enough how far the company has come in the last couple of years as Avaya continues on its transformation journey. Taking a step back, as I reflect on the year, we've moved to a very different place from the Avaya that many of you may remember. We are at the moment in the company's 20-year history to regain our leadership position. We've worked hard to align our company, our investments, and our innovation with where the market is headed, and more importantly, with what our customers want. Let me close by re-emphasizing a couple key points. Our global team has not only delivered on the promises we have made to our customers, but far exceeded expectations. In today's digital-first world, the company has never been in a better position to leverage its true strengths and the value proposition of our core platforms in the cloud. And demand for our large enterprise partners is strong, accelerated by the need to automate, digitize, and implement new ways of doing business. Looking at FY21, we have an opportunity to help shape our customers' futures, and we are embracing it. We will remain focused on public cloud, both UCaaS and CCaaS, private cloud, and workstream collaboration platform with our Spaces solution. In closing, the company is successfully navigating through these challenging times while we continue to strengthen our position to lead our enterprise customers as they accelerate their own transformations. With that, we're now happy to take your questions.
Thank you. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the queue. You may press star 2 if you would like to remove your question from the queue. And for participants using speaker equipment, it may be necessary to pick up your headset before pressing your star keys.
We should revisit?
Everything that I had written down for Jim's, we went back and did or discussed. Kieran, no, I think the final cash flow ARR section should be fine. Running through it those couple of times, and that was the only thing that was up in the air for me from his.
All right, and Kate, mine came across okay.
Hey guys.
Yep, everything is good. I have my notes on my end, and I'll start working on this once we all just.
Our first question is from Lance Vitanza with Cowen and Company.
Appreciate it. I'll look forward to hearing from you, and we'll get your
hi guys, can you hear me? It sounds like there's some
if there's anything,
tape play
that,
on the call.
that we need to re-record after listening to the edited file.
I can hear you. I'm sorry.
I'll reach back to you.
Mike.
Okay.
All right, great. Guys,
Thank you all very much.
All right,
All right, thank you, everyone.
Thanks.
Bye.
Bye. Sorry, Lance.
Hello? Hey,
I can hear you,
no
Lance.
problem.
Yeah,
Okay, great. Great job on the quarter. I mean, it sounds like everything was better than expected, but was there any revenue that you think was pulled forward from the first quarter? You mentioned in the prepared remarks the SSA contract. Could you quantify that or provide some additional color around that circumstance? And then I'm wondering, is that pull forward the reason that the low end of your revenue guide for the first quarter is down year over year?
Yeah, hey Lance, this is Jim. I think you can hear us now. So yeah. First of all, thanks for the question. So I wouldn't characterize Q4 as having any pull forward. What I would say, to your point on Social Security, it definitely came in stronger than we had anticipated, as well as subscription was obviously a big driver for the quarter, as a number of our customers are looking to accelerate their digital transformation. Obviously, subscription provides them an easy path to modernize their infrastructure, provides them flexibility to really consume new innovation as products much like our workstream collaboration product in Spaces. So I basically say that, it's really Q4 is a testament to our investments, our innovation, sort of the leadership position that we have in enterprise, and it really intersects well with the robust portfolio and strategy we laid out. As far as this quarter, again, Q4 by all measures was a great quarter for us. But in fact, I would say that Q1 guidance, number one, suggests, as Kieran pointed out, midpoint year-on-year growth would continue. And I also think it's important to note that as we continue to grow in CAPS revenue and our ARR, which we said on the call, we expect to double this year. As you look sort of at the construct, my point is we are continuing to shift more and more of our revenue to a cloud and recurring model. And even with that, we are still expecting growth for FY21.
Thanks. If I could just ask one more on the balance sheet. I guess the question is, why do you, and I'm referring to the slide deck here, but why do you want to maintain $400 million of cash when the minimum is $250 million? And then I guess even using the $400 million as sort of like the threshold level, you got next to $325 million of cash above that level. So what would you like to do with that excess cash? Debt repayment, implement a dividend, M&A, you get the idea.
Yeah, sure. Let me start, and then obviously I'll turn it over to Kieran. So first, obviously, in the midst of COVID, I think it's prudent at this particular point in time, obviously, to have significant cash. And I think at the same time, I think it's also noteworthy to take a look at just how aggressive we've been in 2020, right? First of all, we paid down 8% of our debt. We repurchased 26% of our shares. Kieran pointed out that we basically refinanced and did an amend and extend for close to 65% of our debt, moving it out, from 4 to 6 years. So I think we've been fairly aggressive in a one-year period, even with the last, if you will, 6 months of our fiscal year in the face of a worldwide pandemic, unlike we've seen in our lifetimes. So I would say that we are continuing to work with our board around any and all options. But with that, I'll turn it over to Kieran. You may want to add a little bit more color.
Yeah, no, I think, Jim, you captured it pretty well. Obviously, Lance, as we said in the prior quarters, we do want to continue to be conservative, and just because the pandemic is still raging and kind of unpredictable. Point one. Point two, we have expressed a bias towards focusing on getting our debt lowered and improving our overall leverage ratio. So that would be second on priority. And then obviously we always want to keep a little bit of dry powder as well for any potential investments that we might need to make. But right now I'd say first and foremost is really focused on just weathering these rather uncertain times overall at the macroeconomy level.
Thanks, guys. I'll get back in queue. Appreciate the time.
Yeah. Thanks, Lance.
Thanks, Lance.
Our next question is from Raimo Lenschow with Barclays. Please proceed.
Hey, congrats from me as well, and thank you for the extra disclosure. That's really, really helpful. First question is, Jim, if I look at the ARR guidance, the long-term one, the $1 billion in FY23, that to me suggests there's obviously still a lot of stuff still coming, and we're only at the early innings. Maybe talk a little bit about where we are in ACO. You mentioned you're in some countries, and you still have a doubling of partners, and then CCaaS as well. Like, it seems we're still in the early stages, so this is just the beginning of a journey. But yeah, I'm just trying to, like, the $1 billion in ARR seems like a big number. And then I had one follow-up for Kieran.
Yeah, no, that's a great question. Thanks, Raimo. So a couple of things. So one, on the ARR front, as Kieran pointed out, we've worked hard with our strategy that we laid out in really becoming a cloud and SaaS company about 3 years ago. And I think we're right on track to executing on that strategy. So a real testament to the employees here we have at Avaya. They're executing extremely well. And it is obviously in the next couple of years to get that number crossing $1 billion is clearly, obviously north of 35% range as part of overall revenue. So a pretty steep ramp, but again, we have high confidence in our ability to generate that performance. As far as ACO, we really are in the early innings. I mean, obviously we're only in month 7, month 8 of the overall deployment of ACO. Clearly, the first quarter was just predominantly in the U.S. Over the summer months, we've added a few countries, and we've just announced that we're going to be adding 5 additional countries, and they'll be on board by the end of December. So we have 12 countries now that we are now out and rolling out ACO. And we have expectations, obviously, as we move into the calendar year 21, that we'll continue to build on that. We are excited, to say the least, about where we are with the performance and acceptance of ACO, not only from our partner community, but from enterprise customers as well. And obviously, we are putting, if you will, a significant amount of investment into our ACO infrastructure and our go-to-market organizations and our support organizations, if you will, like customer success and inside sales. And more importantly, as we continue to roll this out in each of the countries around the world. And as Kieran pointed out, we're going to at least invest at least 1 point of our EBITDA performance back in, like we did this year. So back into the go-to-market functions, as well as continuing, in fact, grow our investment in R&D as we go through 2021 in order for us to execute on the plan that Kieran just laid out. So I would say we're really excited. I think we're right on where we thought we would be with ACO at this particular time. Obviously, doubling the number of customers in 1 quarter is significant. As we look at our backlog, as we look at how well we're integrating organizationally with Ring, I think has actually been a real pleasant surprise, for lack of a better term, with how the organizations are gelling and how we're collectively going to market. And we're as I said, we really only have a handful of countries that have any more than about 3 months of go-to-market time under their belt, but we have high expectations in FY21. And as we look at our funnel and our pipeline, I would suggest that we're pretty comfortable with what we're seeing on the horizon for our ACO market acceptance.
Perfect. Thank you. And then the follow-up for Kieran is, if I think about profitability, obviously we're living, lower travel costs, et cetera, and I get that in your guidance. But in what respect has these kind of crisis reshaped how you think about kind of field spending, et cetera? It's unlikely we're going back to the old normal. There's going to be likely a new normal. Like, how much your guidance includes like a new normal versus an old normal? Thank you.
Sure. I think, Raimo, as Jim pointed out, there's a couple of things going on, a couple of dynamics going on. One is the dynamic of we will return to some level of new normal activity. And I think you're 100% right. It will probably not be at the same levels of T&E, travel and entertainment, as well as even facility spending. We've been able to do some right sizing as we go through time. On the flip side of it is, I think our early entree here now with ACO and our CCAS offerings, recognize that we need to continue to build out our go-to-market infrastructure, especially in support of our channel partners as well. So I think what you'll see is a kind of a shift of the emphasis in spending into more of the bulwark behind, laying out that full ecosystem of go-to-market, and that's what we've contemplated in our guidance for fiscal 2021.
Okay, makes sense. Thank you.
Thanks, Raimo.
Our next question is from Meta Marshall with Morgan Stanley. Please proceed.
Great, thanks. I wanted to dive into the contact center a little bit. Maybe first question, you noted some improvements in your press release on additional feature sets, but if there's any other critical development milestones coming up, so you would hope to have a lot of that product finished by the end of the year. And then maybe second, just initiatives to push that customer set to kind of the subscription product and where you think contact center as a percentage of revenue can go from the 40% you laid out from fiscal 20. Thanks.
Yeah, hi, Meta. This is Jim. I'll address it first. So, on the contact center, we're obviously we announced the product roughly about 6 months ago. We're actually quite pleased on our progress to date. We're predominantly more around sort of a digital solution with our contact center. We have follow-on releases as early as in the next, I would say, 2 months or so, where we'll be moving outside of the U.S. and Canada. So we'll be moving to roughly about, I'd say, 30 countries plus or minus associated with that. We have enhanced, obviously, features and content that we'll be building into the product in very short order around omni-channel, bring your own carrier, and a number of other significant features in the marketplace. We have the teams deployed. We're ramping up, obviously, our go-to-market functions in order to go execute and sell that with not only the partner community, but as well as our service provider community and our direct workforce. One of the reasons why we brought Stephen Spears on to the company back in September, who's a proven cloud leader in his previous jobs, and we're already making and enhancing, I should say, our go-to-market functions to provide the capabilities needed as well as the systems to execute on that. So we think we're in very, very good shape. And what I'll do is I'll turn it over to Anthony, who's here with me, to give you maybe a little bit more insights into sort of where we are in the progression.
Sure. Thanks, Jim, and very good question. So we've introduced, we're continuing with the milestones that we've laid out on previous calls. We've introduced digital channels into that beta that Jim had mentioned. We're expanding into EU via the UK and Ireland, followed by Mexico, and you'll see those coming in January. And we've already seen our funnel double over this last quarter that we're reporting on. So we're seeing some good progress there.
And as far as just in terms of kind of percentage of revenue or initiatives to push the customers to those new products.
Karen, so I would tell you we are seeing, obviously, with subscription, with significant uptake, as we pointed out. A key component of that is obviously with the contact centers and really deploying our subscription offer out there. It's been accepted far beyond even our wildest expectation. Our contracts are in the range of 3 to 5 years. So it's a nice entree into fortifying our relationship with our customers, but more importantly, providing them an easy avenue to upgraded technology and entree into cloud. We are also seeing, as we now have a year under our belt with subscription, a number of those customers coming back as we would expect and asking for, at this time, private cloud solutions to take sort of subscription to the next level and really moving to an overall private cloud solution, again, which we're excited about with the opportunities in front of us. So we're seeing nice growth in 2020 in contact center. So we're really off the heels of subscription, and it's actually executing to our plan on an entree, if you will, to the cloud. So Karen, I don't know if you want to add any more to that or not.
No, I think, listen, you guys covered it. I mean, obviously, just as you said, with more of the subscriptions that we've seen to date really being contact center driven, we would expect that the 40% would continue to grow. And well, I don't have a real formal number out there, but we certainly think longer term it could be more than half the revenue of the company.
Great, thanks.
Our next question comes from Samik Chatterjee with JP Morgan. Please proceed.
Hi, good morning. Thanks for taking my question. I had a couple, and if I can just start with asking to get your thoughts on the regional variance that we saw in the momentum of revenues. North America did better, and I think the other regions were a bit more kind of flattish quarter on quarter. Outside of the government spending, are you seeing any impact or any variances in terms of customer conversion or wins between the regions, either because of the macro or where your product kind of roadmap or launch expansion is at this point? And I have a follow-up.
Yeah, sure. Karen, you want to take that one, and I can add a little bit more at the end.
Yep. So, hi, Sam. Yep. So first of all, I think the U.S. government absolutely did very well, but I would say we across all the industry verticals in the U.S. We did very well. In fact, even in some of the industry verticals that we were concerned about, who were most heavily hit by the COVID pandemic, we behaved better in those industries as well. I think the issues that we've seen internationally is really that the shutdowns have had a bigger effect in their ability to conduct business. A lot of the business is very personal in these jurisdictions, and I think that's why they've struggled a little bit more than what the U.S. has. We do see now with the international starting to adapt the migration to subscription quicker. We'd expect them to start to catch up as the year goes on. But across the U.S., I'd say it was strong across all of our industry verticals, and international really more heavily impacted by COVID.
Sorry, maybe I'll just ask my follow-up then, which was also for Kieran here. On Kieran, you're guiding to about a $300 million increase in GAAP's revenue, and based on your guidance for total revenue growth being kind of 0 to 1, that would imply about like a $250 to $300 million decline in the remainder of the business. So I just want to see if you can give me kind of the broad buckets there of what are the primary areas that are driving that decline of 250 to 300. I understand the move to subscription, but don't think that drives some of this decline. So that would be helpful if you can bucket that for me.
Sure, but I think overall we have been very quick to acknowledge that just market trends from the traditional way of selling product have shown that premise-based product is going to be declining, especially under a CapEx model, by high single digits to low double digits as we go through time, and that's what we factored in. We expect to continue to see that the traditional business, especially from a hardware perspective, will continue to decline, very consistent with the market trends. I mean, that's really the massive churn that you're going to see in our business as we go through time. A very significant part of our business is still premise-based in terms of a lot of the maintenance that's out there, and that all has to work its way through. So we expect that portion of the business to continue to face headwinds as more of the business starts to shift to subscription and cloud, and we'll start to see that more than offset it obviously with our growth projections for the full year and longer term. But just in the current period of time, it really is coming from our traditional premise-based product business and the maintenance that is associated with it.
Thank you.
Our next question is from AVYA Merchant with Citigroup. Please proceed.
Great. Thank you for taking my questions, and congratulations on a strong quarter. Kieran, one quick question. As you kind of look forward, you gave us some great metrics on how to think about the transition from fiscal 21 to 23. And just want to kind of understand, as you look at your long-term model, as you get to those cash flow metrics, what are some puts and takes that we should think about from the EBITDA margin perspective? And as you look at fiscal 21 as well, again, if you can walk us through some of the puts and takes to your guide, what could drive it coming to the lower end of your guide versus higher end, some things to keep a look at. Thank you.
Sure. Yep. So I mean, firstly, I would be naive if we didn't acknowledge that the COVID pandemic is still out there. And, while we feel we've got a pretty good insight into our customers, from a funnel perspective, as Jim pointed out, and we think we got good control of the business. I mean, quite frankly, we've seen some of our guys reporting in internationally, especially in some of our European countries, that the businesses are shut down almost entirely. And that's always a concern that you have to acknowledge. So that's the one thing just tactically that we would think about. Over the longer term, I mean, we really do see more of the business migrating to subscription, as I pointed out in my prepared remarks. We expect that more of that subscription, our subscription bundles, are going to be delivered more as a service. So more cloud content, which means we'll be taking more and more of that ratably. So while we should see an increase in bookings as reflected in our ARR metric that we're talking about, more of that revenue is going to come after over time. We are doubling down, as Jim pointed out, on the investments that we made from a cloud perspective, especially from a CCaaS perspective. And then we're funneling, obviously, a lot of money into our go-to-market. We've had a good opportunity over the last 6 to 8 months to really learn a lot about, selling public cloud and, understanding what it takes to fully support that end to end. So those are the types of things that are factored into the next year from a EBITDA perspective. And I think we have that pretty well bracketed in terms of where we should be. I mean, I think we've demonstrated time and time again we're pretty prudent in how we manage our cost and expense, and we should have that pretty tightly managed. Longer term, the opportunity to truly scale our cloud offerings is really going to give us the ability to expand. Is going to give us the ability to expand our margins. We'll become more efficient from a cloud go-to-market perspective, and we think there's opportunity in our sales go-to-market as well. As we've always said, we think we'll continue to see some improvement in our product gross margins as we start to move away from hardware.
Great. Thank you.
Thanks, Ed.
Our next question is from Rod Hall with Goldman Sachs. Please proceed.
Hi, thanks for taking my question. This is Bala Reddy on for Rod. I just want to double click on the CCaaS momentum there. Wanted to see if there is anything that you could do to help us understand the size of it and how big it was. And then maybe talk a little bit about the sustainability of that business too. And I got follow up.
Yeah, sure. Yeah, hi, this is Jimmy. I'll turn it over to Anthony, give you some perspectives into what we're doing on CCaaS, and if DP, I'll add a little bit at the end.
Sure. What we're seeing is that the take-up rate is quite interesting with our customer base. What we find is they're approaching us on the CCaaS pure cloud public part of our business. And as it starts to roll out in multiple countries, we're starting to see that funnel build. I mentioned a little bit earlier that it's doubled just within the quarter alone. In terms of the sizing, that's going to depend on how quickly we get the rollout in each of those separate countries. And if we see that customer doesn't sort of roll immediately into a public cloud solution, a lot of the times they start to see the breadth of the portfolio and move into our private cloud solutions or our hybrid type of solutions. So you may see, and we do see, a distribution of the customer coming into our storefront looking for a public cloud CCaaS solution, but end up leaving the store procuring a hybrid or a private cloud solution, or sometimes enhancing their on-prem through subscription. So that's what we're seeing. So you're seeing that some of those numbers spread across that particular the particular portfolio because we have that particular breadth.
No, thanks, Anthony.
Our next question is from Catherine Trebek with Colliers. Please proceed.
Oh, congratulations on the strong quarter. My question has to do with the change you're seeing in sales. With the pandemic, you're seeing more digital marketing, even the VARs looking to switch more to digital marketing framework, fewer face-to-face meetings, as you noted, even happening now in Europe. So what initiatives are you putting together for this change? And I think, I think it'll be the new normal. And then is that affecting the size of your sales force? And are you shifting people maybe to do more inside sales, et cetera? Could you just kind of go through that for me? Thank you.
Yeah, sure. This is Jim. So that's a great question. And, obviously one of the reasons why we brought Simon Harrison on and joined us back in January as we sort of refocused and doubled down on our overall marketing efforts here within the company. And Simon and team have been doing a great job, especially as you point out in the world of digital. And I'll ask Stephen Spears, who's here with us, to add a little bit more color to that. But as far as our overall workforce and what are we shifting, we are under a bit of a transformation within our go-to-market efforts. We are obviously adding to not only our inside sales teams globally, but also customer success teams as well as we deploy more of our cloud solutions out into the marketplace. And secondly, we're adding a number of what I'll call specialists in really generating cloud, especially with our larger enterprise customers. And in fact, we've added a number of folks into the organization that have the experience to work with partners, as not only we're transitioning our current VARs from hardware on-prem type sales, but also adding a number of new partners that are solely have their expertise in delivering cloud solutions to the marketplace. So there's been a fair amount of transformation underway. I think you'll see a bit more here in the company, so that we're in a position to leverage and satisfy our customers' demands with our overall cloud solution. So it's actually pretty exciting, and even the current Avaya team is actually very excited about an opportunity to drive and sell and actually go to the customers with solutions that they require. But a little bit more insight into the actual what we're doing from an overall marketing perspective. Stephen, I don't know if you want to add anything or not.
Well, thank you, Catherine, for the question. I do believe that we're seeing a tremendous shift and a lot of momentum as it relates to reaching to our customers and partners in digital methods. You can see that we were able to execute very strongly. We gave away a number of free trial licenses at the beginning of COVID. That turned into really a windfall of net new business in the quarter. And I think as we continue to evolve our offerings, we'll continue to reach into those digital channels and really provide a lot more frictionless commerce opportunities for our customers to leverage during these unprecedented times. As Jim alluded to, you can look to a number of changes that will continue to evolve within our sales methodology, but really that key focus on customer success. And now as we transition these customers into subscription, you'll see a renewed focus from Avaya on that customer success component.
All right, thank you.
Our next question is from Mike Latimore with Northland Capital Markets. Please proceed.
Great, yeah, congratulations on the strong results this year.
In terms of the subscription bookings, I think you said $400 million in fiscal 20 here. How much of that $400 million are you likely to recognize in fiscal 21?
Kieran, you want to take this one?
Sure. So Mike, as we've laid out, illustratively, we take anywhere from between 50 and 60% of the premise-based at point in time, given the subscription, given the premise-based content within it. So, I think the illustration that we put out there, that, of that $400 million, you'll probably get, somewhere on the magnitude of about 25% more per quarter, per year in the following years. And then, you have the opportunity, obviously, to, when you renew it again, to renew the point in time portion of it again, assuming that it doesn't change, the bundle doesn't change in year 4.
Okay, got it. And then it sounds like you're having a lot of success in the contact center segment. I guess, is there any way to highlight or describe what percent of some of your top contact center customers, whether it's top 20 or 50 or something, that are on subscription already?
Kieran, you want
to? So honestly, I don't have it at the tip of my fingers right now. We did move some of our largest BPOs back in third quarter, in second and third quarter. So I know that very very clearly 2 of our largest contact center customers were moved. We've also had a couple of big banks. I tell you what, maybe give me a chance to come back to you guys on that one. I mean, we've been trying to manage it, from a migration perspective, given when the natural renewal cycle comes up. But we have moved, like I say, a couple of our bigger banks and a couple of our larger BPOs.
Yeah, I think, Kieran, I think the meta point is that we're at our very early stages of that transition on the contact center, so very early innings.
The other thing,
Mike, the other thing we're starting to see now in the last quarter is the fact that we've won a number of new customers with our subscription offer. So it was originally designed, obviously, to go after our install base and enhance our customer base that was predominantly on a maintenance contract, and then provide them the accessibility to new technology and drive if you will, that OpEx model. But the solution has been so successful, we're starting to see a number of greenfield new customers sign on to subscription, and we expect that will continue as well. So again, another opportunity for us as we move into 2021.
Great. And just last on professional services, how have they been doing lately? And I guess, do you recognize those kind of at this point in time as well, or is that get built into a ratable recognition?
Yeah, this is Kieran. So services is all tied under 606 accounting to a percentage of completion. Mm-hmm. So as you deliver, unless there's very specific milestones and acceptance criteria for the customer. So no, it tends to be just based upon deliverables.
Yeah, and as far as
lately.
Yeah, our APS revenue is basically flat from FY19 to FY20, which is one could expect. Actually, I think that's actually very good performance, especially with COVID hitting a number of our customers and more importantly, the sort of the large enterprise where people are not at work. So obviously they do a lot of work virtually, but still APS is still sort of a person sort of human interaction with the customer base. So the fact that we were flat year on year, I think is actually really great performance and bodes well for us as we go into FY21. So we're certainly pleased with our professional services revenue and organization.
Yeah, great. Yeah, thank you.
And our final question is from Hamid Khorsand with BWS Financial. Please proceed.
Hey, good morning. I just wanted to see, is there a difference in economics between your Avaya Cloud Office and OneCloud? Is there a particular product that you were looking forward to push this year versus the prior year?
I'll start off with that, and then Kieran get into the specifics. We don't necessarily push any product over any other product. We have a very robust portfolio, which is great. In fact, more than most of our competitors, because we provide the opportunity to do public, private, and/or hybrid. So when we sit down with our customers, we listen to our customers. We obviously have an opportunity and present the different optionality for what their needs are. So we don't, if you will, portray one versus another. We are a customer-led organization, and it's great that we have the portfolio and offerings really to tackle any segment of the industry we participate in. As far as overall, from a financial perspective, I don't know, Kieran, what color you can add to that or not.
Sure. I mean, I think as we've laid out in the past, obviously the ACO offering, because we're not hosting it, is actually, mirrors in many ways sort of a premise-based license, so high, relatively high gross margins and the like. And then obviously, you're ramping your own cloud. But I would think over time, when you take into account the full go-to-market costs and all the rest of it, they're all fairly consistent in terms of the bottom line profitability.
Okay. Thank you.
Yeah.
Okay.
I would now like to turn the conference back over to Michael for closing remarks.
Thanks for joining us, everyone, this morning. I appreciate your time. We look forward to speaking with you over the days and weeks ahead. We should be reporting the December quarter early in February, and we'll get note of that out as we get closer to that date. Thanks very much for your time, and enjoy a good holiday season. Take care.